Hi, and welcome to your Tuesday Q&A marathon, where we talk macro, try to make sense of markets that don't really make any sense, but more importantly, answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me, because right now we're going to answer your questions. Let's go. Just some questions when you have a chance to discuss during your show. How about right now? Basel III, this is a banking regulations. For those who are not familiar with Basel III, and don't worry, there's no reason you would be, would imply that the gold reserves are to be taken as 100% collateral for cash, if I understand it correctly, instead of 50% at present. What impacts will it have on the financial system? Now, it's kind of interesting that you sent me this question, because I was looking over the Basel III regulations this weekend. I know, pretty boring, right? I hate banking regulations. I actually did find a PDF piece that kind of went through the three tiers of collateral. And I specifically was looking, because I got your question, I was looking for gold or precious metals, and I didn't see it. Now, doesn't mean it's not there, because anyone who's bothered to look at the Basel III regulations, either you're required to by your job or you really have nothing better to do with your time. If you find something, can you send me the link, the PDF, send me something, that way I can look at it, because as far as I can tell, I don't have the answer to that one. But let's go on to your second part of your question. It has been suggested that the crypto golden yuan is the future reserve currency. Since opening the economy, China has pushed crypto yuan transaction to a new level. What are your thoughts on cryptocurrency taking place on a bigger scale, and whether transaction can be done without severe turbulence to the system? First off, I do not see China becoming the reserve currency, whether it's crypto, whether it's gold. I do not see them becoming a reserve currency. And it's because they don't want to. I mean, and believe me, we don't want them either. I mean, are you really going to trust your currency? And I mean, because that means instead of dollars, we'd be trading in yuan. I mean, would you really honestly trust that? Yeah, a lot of people wouldn't. I would think almost everybody wouldn't. And it's okay, because being a reserve currency is both a blessing and a curse. Now, for China, they are an exporting nation. When you become a reserve currency, you become an importing nation. That's not what they're set up for. So no, I don't really think they want to be a reserve currency at all. I believe they want to be maybe a regional reserve currency to trade with other countries, but not on a global scale. Not like the dollars, no. Do I think crypto will play a role in the future? Yes, there will be a point where I believe we do not have any paper currency. For some of you, this sounds like a wonderful idea. Wait until we don't, and then you'll realize why the older people watching this are going, oh, no. You want paper currency. Yes, you do. But nevertheless, that day will come. I do not think things like cryptocurrency will take the place of, say, merchant transactions. So like you go down and buy a soda, you stick your credit card in the vending machine, pull it out, and you get your soda. I don't think that gets replaced by crypto. I don't think there's a need for that much verification of like, all right, did Steve buy a Coke or a Pepsi? God, we all need to know what vending machine and what he got. It's not that important. But from an intra-bank or international trade standpoint, yeah, I think we get there. Now, I do not think it will be any one of the mainstream cryptocurrencies out there. If the notion that, hey, I'm going to buy, say, a Bitcoin or something else because the world's going to adopt Bitcoin as the standard and I'm going to become a multi-trillionaire, I don't think so. If you think for a moment the Fed or any major central bank is going to use someone else's creation, no, they'll have their own version of it where they can control it. Why is it a dichotomy with bonds and stocks? Why not a third? Say Forex. I don't know. All I know is stocks and yields generally go down together. I know stocks and yields generally rise together. And when they're dislocated, as they are right now, trying to grab that with one hand, something will eventually correct. Either stocks prices will go down or yields will go up. The bet should be pretty obvious the stock prices will go down, not to most investors, but hey, the Fed's doing QE, that's what it's going to do. Now, if you find the relationship between that and a currency, let me know. Send me your graphs or charts, and maybe we can put it on a future show. But there could be, I just don't know. Or are you saying that deflation will happen on a global scale? Yes, it is. Not only Will it happen? I'll go further and say it is. We're seeing it right now live. It is happening right now. If you look at the global CPIs, you look at the global import-export indices, it's pretty clear to me. Steve, question for your next Q&A, if I may. How about now? Perfect. When everything seems overpriced, commodities, stocks, bonds, etc., and cash is trash, as Dalio says, what kind of assets should us millennials be looking at to invest for the medium long term? There doesn't seem to be anything good value right now. Yeah, that's one of the hardest things to do as an investor is wait. It's so hard. So the short term, you could be looking at Treasury bonds of some flavor, maybe to pick up some excess yield over cash and a positive carry if you believe deflation is coming. But one of the hardest things to do as an investor is just stack up cash and wait. Stack up cash and wait. Your day's coming. It could be next week. It could be next year. It could be 2 years from now. You just got to keep stacking up cash. And so maybe it's stocks you want to buy. Maybe it's real estate. I don't know what it is. But deflation will bring you that opportunity. The question is, can you be patient enough to get there? And that's what macro does. It teaches you patience. It tells you opportunity is going to come. And believe me, my dad's always said this, ever since I was a little kid. He says, you got to have money because you never know when opportunity knocks. Do you know how I bought my first car? And I did buy it, but I was not the original transaction. And my dad's, I don't remember if it was his boss or one of the managers where he worked, said, man, if I could sell my mom's car right now for $500, I would. My dad reaches into his pocket because he carries his some checks with him. I don't know if he still does, but he used to. And he started writing out a check for $500 because he had the $500 and he knew it. I think I was 15 at the time, and it wasn't a great car, but hey, it got me to school, right? Sort of. It was the ugly. Now my wife's going to contest this in the comments. I had the worst car at school, the absolute worst. And my dad's like, "That's not possible." He drove through campus. It was like, "Yeah, all right." Now, my wife claims that's because she wasn't there because she's older, graduated before me, that she had the worst car. So there you go. Maybe that's why we're married today. But that boss, he honored the deal because he had to save face in front of all the coworkers that he said, I'd buy it right now. And opportunity knocks like that. I had an opportunity where I made a bunch of money on a real estate flip, because my former roommate got a call from one of our friends, a realtor, and says, hey, I've got 2 homes that the buyer fell out. They're almost done. I need someone to come in with a down payment. When it closes, get the loan, we'll flip it. He didn't have the money. I heard about it, called the realtor. He literally came by and picked me up. We went out and I ended up buying 2 homes in one day, sold back one of them to him because I didn't want to carry 2 properties. And I think I made 6 figures on that deal. And I did it in less than 6 months. So opportunity knocks to those who have cash, and you got to be patient and let the deals come to you, and they will. They'll show up, and it'll happen. It's just long term right now. No, not much, nothing. I just watched your Q&A. I'm so frustrated because I don't feel like you answered my question at all. You entirely skipped over the context of my question. All right, so let's address this. I answer questions for free, so don't be frustrated. I'm not going to answer every question right. I'm not going to get everyone the way someone wants. We're a community. We're a group. We're a team. And I have the right of refusal not to answer something or to skip something. But I also give you the right to rewrite your question and resubmit it. And I do not penalize you. So don't be frustrated. I explained that I do understand the Fed doesn't purchase from the Treasury directly, but you skipped over that part, so let me try this another way. Now, I highlighted this. Let's take a hypothetical situation. So let's stop right there. I don't want to discuss hypothetical situations with monetary policy. I don't. So the person who sent me this is going to be even more frustrated because I'm not going to answer it. And as a captain of this ship, I want to talk about, we are going to talk about some things that are hypothetical. Like, all right, well, how does the dollar end up hyperinflating? That's a realistic question because some people are concerned about that. How does that work within the constructs of our monetary framework? But I do not want to get into what if this happens instead of that? It's not. The laws are very clear on how the system works. It will not be until we see some winds of change that I'm interested in discussing that. So I'm going to apologize to you right now, whomever sent this in, and I know your probably frustration level went to here, but I am going to punt on this question. So let's go to the next one. Follow-up question. Please explain what power the Treasury has to increase the base money supply and how that works. Oh, here. Follow-up question. Please explain what power the Treasury has to increase the base money supply and how it works. They don't. At all. None. If you're okay, this is a really interesting question, because when I got it, I was kind of excited about answering it, because every once in a while I get one of these questions and I get excited about maybe having an answer. And I spent all weekend, and the person that sent it is not going to like the answer. If you had the opportunity to talk to Jerome Powell last week after the Fed meeting, ask him one or two questions, what would you have asked? Thank you. Can't wait to hear your response. I couldn't come up with one question. I really couldn't, because one, I know he wouldn't answer whatever it was I came up with, because he's not going to. But would it be about yield curve control? Well, we already kind of know the Fed's fairly transparent with their trial balloons. Would it be like, hey, are things really worse out there than you're willing to admit? Nah, we already know that. So the problem is there was really nothing that I felt I could ask him that I didn't probably already have a pretty strong clue of what the answer was. So yeah, I'm kind of bummed out too. So I'm sorry that you waited to hear me say that I didn't have a question for him, mainly because I didn't assume he'd answer it. I'm looking at Treasury bonds, and although they went up during the February crash, I'm not sure why they fell so hard from March 9 to 19. I'm wondering what caused everything to crash from March 9 to 19, including stocks, bonds, gold, and Bitcoin. If there's a similar crash to find all relationships between these entities, then perhaps expecting bonds to shoot up might actually not happen when stocks have their second leg down. Okay, so what happened? We had a liquidity crisis and people were needing bonds. Now, we knew this was going to happen because the Fed was doing repo operations, which is when a commercial bank borrows cash from the Fed for a short period of time and gives the Fed a Treasury security as collateral. This always leads to liquidity events. Always. And I said it when they started doing it. I'm like, all right, we're going to have a liquidity event. This thing's going to blow up. It just so happened the Fed was so far behind the curve that as the dollar shortage hit and asset prices were crumbling because people were scrambling for dollars, they had one thing they could do: sell treasuries. And they did. And so the Fed had no choice but to come in and mop this floor up. Now they're doing QE. We know QE causes the dollar to go up. We know QE causes treasury yields to go down. So we already know what's going to happen because the Fed's going to continue doing them. So I'm going to stand behind the fact that I still think bond interest rates go to zero. And if you think about it, if you look at lending demand, which is what we do every Friday on this show, is there's no lending demand. It's still falling. It's still bearish. It's not contracting yet, but in the credit card space it is. But that tells you that interest rates are too high. I mean, we already know that. What we haven't seen is the market admit it. They will. Thanks a ton. Great show. Keep it up. I'm discussing with quite a few folks on Reddit, and it seems like everyone is watching your videos nowadays. Man, that is super cool. Well, hey, thank all of you for watching. Next question. So a follow-up, just from the same person. Do you expect a similar illiquidity event to occur again? I expect a bigger one to occur because the Fed didn't fix the first one. Has the Fed already put regulations in place to avoid it again, with having stricter requirements for banks for reserve percentages needed on lending and so on? Had nothing to do with that. What it had to do is there's a shortage of dollars in the global economy. There still is a shortage of dollars. The Fed does not have the tools to fix it, so they can't. So all they can do is simply put a Band-Aid over the wound, and even though it's seeping and there's more blood and it's going to get infected, all they can do is throw Band-Aids on it until the whole thing falls apart and you get that big deflationary crash like we do in your typical recession. My logical mind says if the jaws can close, then they should also be able to reopen in the opposite direction. Now let me see if I understand this question. So currently we have stocks up, bonds flat. And I'm saying the jaws are going to close and stocks are going to come down, right? to meet Treasury yields, who are going to go down, something like that, and keep going down. That's what I'm. So if I understand the question correctly, is can yields, could stocks say go flat and yields go down? Yeah, they can, but stocks will follow. If I understand your question correctly. And if that has ever happened in the past, can we see a little history of what events in the news in those years caused this? Well, you're welcome to run a chart of 10-year Treasury yields against the S&P 500, and you can go back and look at dislocations and find out what news events may have caused that. You can certainly do that. Also, in the same line of thinking here, why must the jaws close instead of simply having a perpetual one after another event which keeps them open? If you think about it, the jaws are open now for a reason. Yeah, they are. And the reason is simple. Stock investors think inflation's coming. The bond market is the sayer of truth when inflation. I mean, there is no better way to determine whether there's inflation or not if yields are low. That is what disinflation and deflation is. The only way you get higher interest rates is when there's more lending demand than there is capacity. Then the banks mark up the yields to find out who really wants to borrow money. So the bond, that's what's so great about the bond market. It in its own existence tells you what's going on. That's why you'll find out some of the biggest macro people in this country follow the bond market and almost no one else does, because the bond market is effectively telling you at any given time what the current state of inflation really is. You don't need the CPI, you don't need any of that junk. You can just look at yields and determine if yields are low or falling. That is disinflation or deflationary. Why can't similar reasons keep popping up over and over, making a situation where the jaws always stay open? Because at some point, investors figure out there's no inflation and asset prices go down. That's just the way it works. Because in a deflationary environment, what's not being created? More dollars. And what do you need in a continuous auction of stocks? More dollars, right? You need more people buying as people are selling to drive prices higher. Well, in a deflationary environment, what do you have less of? Money. Because what happens in deflation? People's pay gets cut. And if your pay gets cut, guess what? Your 401k contributions get cut. And some people, when their pay gets cut, stop their contributions. So when there's less money in the economy, there's less money to chase stock prices higher. So no, I don't think that this keeps popping up over and over. I mean, there's certainly temporary dislocations, but the longer run trend, they move together. What type of news events keep it open? I believe it's more investors that keep it open. I mean, the news right now is very deflationary and disinflationary, and yet investors keep bidding stock prices up. So I don't know this is a news event. So my advice to this person is go back and run a comparison chart and see if you can determine if there's a certain type of news event that does that. Great Q&A session last weekend. Fantastic insights. You're very welcome. I understand Treasury yields have to go down. No question. Good. But let's try to think where there might be some sand in the machinery. Okay, I like that. Let's do that. If the long-term Treasury rate goes down, say to zero or even negative, I'd love that a lot more than you know. Okay, I'd really love it. Why should Treasury bond holders be attracted to buy and hold? Wouldn't the Chinese, Europeans, everybody massively try to sell their losing bonds? Wouldn't it be an unintended consequence, and for the Fed, not so good consequence, potentially driving yields up? What would happen to the dollar? Yeah, that's a good question. I don't think people will hold it. When I say certain people won't hold it, I'm specifically referring to someone I know who would not hold it. I would probably want to sell when they got to zero. But that means other people are going to be buying. That's the great thing. Not only the Fed's going to buy, but all the people that are chasing stock prices higher when stock prices come down due to deflation, what do? What do American investors do? They buy what is high and rising, and that would be Treasury bonds. See? Investment psychology right there. That's what they do. Now, why do other people have to buy it? Well, some places like banks by regulation have to buy them, so they'll buy at zero. Some people simply believe, look, just because something is a zero doesn't mean we can't go negative. We've seen negative in other countries, so there maybe is more meat on the bone. What would happen to the dollar if yields go up? I'd be bearish on the dollar at that point. Part 2 of question. Mr. Trump wants to win the election. I I'm not going to argue with that. So he might want to seduce you with more MMT-like sweets. And later on, who wants to take them away? That's right. This is M2. No, it's not. Therefore, inflationary. No. There's no money's being created. No. The government borrows from the public and gives to the public. Think like Robin Hood. Take from the rich, give to the poor. It's effectively what it is. No money's created. The M2 is only depends on what people do. So if I get a government stimulus check and I put it in the savings account, that causes the M2 to go up. If a commercial or a corporation borrows money and puts it into the savings account, it causes the M2 to go up. If I sell my stock or bonds in my brokerage account or my IRAs or 401ks and put it in the money market, that causes the M2 to go up. So no, giving people stimulus checks is not necessarily inflationary at all. It's just moving money from one pot to another. Now, how would it be inflationary? I think that's probably a better question to ask is, let's say I got a stimulus check. I went down to see the boy who works at the local Porsche, Audi, Volkswagen dealership as a salesman, and I said, hey, sell me a car. Now, of course, he's a commissioned salesman. He's going to sell me the most expensive car he thinks I can't afford, right? And I want to give him my down payment, and I'm going to buy a foreign car with a loan, and that is how you get inflation. You got to borrow, you got to spend money on foreign produced goods and services and get world dollar liquidity cycle flowing. That's where it comes from. Hey, thanks for your comments and time. You're very welcome. Keep up the good questions. Next, I've been watching your YouTube videos with pleasure, and I hope I understood the things you've been telling us. I hope you have too. I discovered trading due to a great community called Wall Street Bets, which is known for reckless option trading. Hey, that's a great way to make money and then lose it right back. But the reckless gambling only made me want to learn more about the economy and financial markets. That's cool. The mantra, the stock market is not the economy, has been preached often enough now, but doesn't the V-shaped recovery of the stock market need to be backed up by the V-shaped recovery of the actual economy? Yes. See, the problem is the stock market is the U.S. economy. When stock prices go up, what do Americans do when they feel rich? They spend more money. That's bullish for the economy. The problem is the economy is telling stock investors that, hey, you might think this is happening, but deep down, we're not spending any money. So the economy, very bearish. Stock prices are fighting a losing trend. And so, yeah, you can't have a V-shaped recovery in the stock market without a V-shaped recovery in the economy. There is no sign of that anywhere in the globe. So that, again, is more evidence of why stock prices are down. Last question, Steven, when you say bonds, which type of the 7 are you referring to? Some of these, I'm referring to only the one in yellow, Treasury bonds. When I say bonds, I'm 100% referring to Treasuries unless otherwise stated. When you refer to yields, how do we know which one? That's easy. It's Treasury yields. You did not list the one. You said there was 4 and you listed 3. So maybe this is the third one is Treasury yields. So remember, Treasury yields and Treasury bond prices trade inversely. So when yields go down, bond prices go up. When yields go up, bond prices go down. All referring to Treasury yields. This relationship between stocks and yields is Treasury yields. Always Treasury yields. So are you intentionally leaving out the specific type of yield? No. Maybe I think I'm more clear about it than I am. That could be the case. Don't know. But nevertheless, hopefully that answers your question and helps everyone else out. So anyways, we will wrap up since that's my last question for today's surprise Q&A Tuesday marathon, and we'll see you tomorrow on Wednesday. Bye now. The content of this video is provides education and information only. Is not intended to provide investment or other advice. The material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. On personal capacity, opinions expressed in this video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.